Hello my dear friends and welcome to StudyIQ. I am Joycey Joy and today in this lecture we will continue our series of current affairs exclusively for UPSC Civil Services Preliminary Examination 2019. So I am dealing with Indian economy current affairs and this is going to be my lecture number 2. So we have divided the whole series into 4 or 5 modules, and the first module is banking and financial sector, and in the last lecture I began with banking and financial sector. So this is going to be my lecture number 2 from the first module, banking and financial sector. So in total I would be making 10 lectures exclusively for UPSC Civil Services Preliminary Examination 2019, and within this 10 lectures I will cover all the important current affairs in the last 15 months from your Civil Services Preliminary Examination point of view. So please keep watching this series of lectures and also please write to me for any of your suggestions at joycey.studyiq@gmail.com. So before we begin, this is our channel StudyIQ and we are providing pen drive courses for various competitive examinations like SSC and bank courses, UPSC optionals, SSC JE courses, teaching examination, railway examinations, defense examinations, RBI grade B, NABARD grade A, UGC NET, UPSC Civil Services Examination, CLAT exams for various state PSCs and also for various professional courses. You can visit our website www.studyiq.com for more details, or you can call to any of these numbers for more information. Now let us start. In the first lecture we had completed 9 topics. So this is the continuation. Moving on to the 10th topic, that is PCR. PCR is Public Credit Registry. So this is a very important topic. So what is meant by PCR or Public Credit Registry? It is an extensive database of credit information for India. So this will be a database which provides all the credit information, and this credit information will be made available to all the stakeholders like the banks, the regulators, the government, the public. So all stakeholders will have access to this data which is available on the Public Credit Registry. So this will include informations from SEBI, that is Securities and Exchange Board of India, Corporate Affairs Ministry, GST network, and also from IBBI, that is Insolvency and Bankruptcy Board of India. So information will be made available from all these sources. Now again, this is managed by RBI, and reporting of loan details will be mandated by law under the Public Credit Registry. So this is some facts regarding PCR or the Public Credit Registry. Now from your prelims point of view, UPSC can ask you a question: who all will provide information to the Public Credit Registry? So you will think that it is Public Credit Registry which deals with loans, so it is only commercial banks or the government or the RBI which is included in this, or who are the important stakeholders. But Public Credit Registry will have information from SEBI, Corporate Affairs Ministry, even the GST network and the IBBI, that is Insolvency and Bankruptcy Board of India. So this is very comprehensive. So you should have an idea about who all are the contributors or who all will provide information to this registry. Now coming on to the benefits of this registry or the PCR, this will provide credit assessment and primary credit and pricing of credit to the banks. So the benefits for the commercial banks is that they will have an opportunity for assessment of credit and also pricing of credit depending on the risk of the credit. Now for the RBI, it is useful in the sense that RBI will be able to ensure the transfer of monetary policy to the customers. So here monetary policy, RBI decides the interest rates, or the monetary policy committee will decide the interest rates of the borrowings. So whenever RBI or the monetary policy committee makes a reduction in the interest rates, this has to be passed on to the customers. But banks in most of the cases do not pass on the benefits of a reduction in the interest rates to the customers. Now RBI can have a watch on the commercial banks through the PCR or the Public Credit Registry, whether the commercial banks are passing on the benefits of a decline in interest rate to the customers. So in that way RBI will also benefit, and in case of the supervisors or the regulators and the banks, this will help in early intervention and restructuring of stressed bank credits. So This will give an information about the status of bank credit and bank loans. So this will give an opportunity for the regulators and the supervisors in order to identify the stressed assets or the non-performing assets, and structuring or restructuring further is possible. And finally, this also provides transparency with regard to providing credit information to all the stakeholders. So these are the benefits of maintaining a public credit registry, which is a very important topic for your UPSC preliminary examination. Now, regarding a task force which was formed by the RBI regarding the PCR, it was formed by RBI and the chairman was Y.M. Diostale, and this task force recommended that data privacy should be protected in the public credit registry. So this is all about PCR from your prelims point of view. Now moving on to the next topic. Next topic is FDI policy on e-commerce. So here we will see what is the foreign direct investment policy regarding e-commerce or electronic commerce. Now what is the current affair? The current affair is that DPIIT, that is the Department for Promotion of Industry and Internal Trade, that is DPIIT. Earlier it was DIPP, Department of Industrial Policies and Promotion. Now it is renamed as DPIIT. So the DPIIT has issued a clarification regarding the existing rules which are applicable to the FDI policy on electronic commerce or e-commerce. So what is the new notification? Under the new notification, the vendors that have any stake owned by an e-commerce company cannot sell their products on that company's electronic portal. For example, if a vendor has a stake on an e-commerce company or vice versa, if suppose a e-commerce company, for example Amazon, if Amazon has a stake on a particular vendor ABC, Amazon cannot buy products from the particular vendor, or this vendor cannot sell his or her products to the e-commerce platform Amazon. So this is the new notification provided by DPIIT. So in this background, we should understand that e-commerce can be broadly divided into two models. One is marketplace model and the second one is inventory based model. So under the marketplace model, e-commerce firms act as a platform that connects the buyers and sellers. So under marketplace, e-commerce platform is just a marketplace. So what happens in a market? Market connects buyers and sellers. So this is how you should remember it. Now FDI is allowed in marketplace model. The second model is inventory based model. So here inventory of goods sold on the portal is owned and controlled by the e-commerce company itself. That means in our example, Amazon is the e-commerce company, and those vendors or those products that are sold on the Amazon portal will be manufactured by the companies that are owned by Amazon itself. So here the inventory of goods sold on the portal will be owned or they are controlled by the company itself, and that is called inventory based model. And FDI, foreign direct investment, is not allowed in inventory based model in India. So this is what you should understand about the FDI policy on e-commerce, and the rationale is that the small vendors on the e-commerce websites needs to be protected. So in the marketplace model, where the marketplace is provided by the e-commerce platform, the buyers and sellers can meet. So here an equal opportunity is given to the small vendors also to sell their products on the platform. But what happens in inventory based model, the inventory is completely owned or controlled by the e-commerce platform itself, which will provide a favorable opportunity for the big vendors or those vendors or manufacturers who have a stake in the e-commerce company or the platform. So in order to protect the small vendors, the government has decided that we will promote only marketplace model, but inventory based model FDI will not be allowed in India. So this will provide a level playing field for the small vendors. So this is regarding FDI policy on e-commerce. Now moving on to the next topic, that is commodity derivatives contract. Now first, coming to the news or the current affair, the BSE, that is Bombay Stock Exchange, has become the first stock exchange in the country to launch a commodity derivatives contract in gold and silver. So here what is important is that till date, commodity derivatives contracts were available only on two specialized commodity derivative exchanges in the country. They were MCX and NCDEX. So these are two specialized commodity derivatives exchanges in the country. Now, Bombay Stock Exchange has become the first stock exchange in the country to launch a commodity derivatives contract in gold and silver. Now, the launch of the commodity derivatives platform on the BSE will help in efficient price discovery, reduction of time or timeline, and it will also make it cost effective. So in this regard, we should know what is derivatives. So what is a derivative? It is a contract between two parties which derives its value and price from the underlying assets. An example of derivative is futures, options, forwards, swaps, etc. These are all some of the derivatives. So please have an understanding what is derivatives. Now moving on to a very important topic, MPC. I have made various lectures on MPC and MPC related current affairs. You can find it on StudyIQ channel. We would be soon creating a playlist also on different topics so that you can easily identify the topics and you can watch those videos. So MPC is a very important topic. MPC was in the news for various reasons. So we will understand MPC in deep. So NPC or Monetary Policy Committee is the authority that decides the monetary policy of the economy. So monetary policy is basically a policy created by the central bank of an economy in order to control inflation, in order to control the interest rates or regulate the interest rates and the supply of money and credit availability. So government has constituted a monetary policy committee and MPC is responsible for framing the monetary policy in the country. So MPC can use various tools like repo rate, reverse repo rate, bank rate, CRR, that is cash reserve ratio, etc. to finalize the monetary policy in an economy. So we have discussed about all these monetary policy tools earlier in the lectures. So now coming on to the composition of monetary policy committee. It is a 6-member committee and out of which there will be 3 representatives from RBI and 3 representatives from the central government. So government representatives will be nominated by the central government. And here what is to be noted is that no government official will be nominated to the MPC. And other 3 members would be from the RBI. So the first member from RBI is the governor itself. So governor will serve as the ex officio chairperson of the monetary policy committee. Now the second member from RBI would be the deputy governor in charge of monetary policy. And third member will be an executive director of the central bank of the central bank or the RBI. So this is the composition of MPC. And regarding the decisions taken by MPC decisions will be taken based on a majority vote. Each member has 1 vote. And here the governor has a discretionary power, or the RBI governor's role is that RBI governor is the chairman or the chairperson of the committee and therefore he has a casting vote. So here what is to be understood is that RBI governor does not enjoy veto powers. That is, veto is different from that of casting vote. Veto means that if RBI governor is against a particular motion or a decision, the decision will be completely taken away. So he doesn't enjoy a veto power, but in case of a tie, the RBI governor has a casting vote and this gives him and the RBI an upper hand in deciding the monetary policy of the country. So regarding the members who are nominated by the central government, we have seen that they cannot be government officials. So how was this member selected? So selection of the nominees from central government to the MPC will be by a search cum selection committee. So the search cum selection committee would be under the cabinet secretary. So the members of this committee would be cabinet secretary, RBI governor, economic affairs secretary, and there will also be 3 experts from the field of economics or banking or finance. So the search and selection committee will nominate 3 members to the MPC and these members will be appointed for a period of 4 years and they will not be eligible for reappointment. So these are all some of the facts that is very important for your preliminary examination. So they can ask you how is the selection made. So government nominees, how are they nominated and what are the criteria, what is the security of their tenure and are they eligible for reappointment. So such questions are expected for your UPSC preliminary examination. So please have a deeper understanding about MPC. It's a very important topic. Now the next topic is UPI. that is Unified Payments Interface. Now regarding UPI, it is a payment system that is launched by NPCI, that is National Payments Corporation of India, and the purpose is to aid instant transfer of money using a cashless system. So this promotes digital payments or digital transactions. A cashless system is promoted here, and the transactions made through UPI or Unified Payments Interface requires only a smartphone and a banking app to send and receive money instantly. So instant money transfer is possible through UPI, and in the future UPI is likely to replace other facilities that are presently available like the NEFT, RTGS, IMPS, etc. Now coming to the key players in UPI, there are three important players in UPI. The first one is payment service providers, or what we call as PSPs. So PSPs refers to payment service providers. They provide the interface to the payer and the pay. So here the interface is provided by PSPs. Now the second one is banks to provide the underlying accounts. So second important stakeholder here is the banks that provide the accounts. And third one is NPCI, National Payments Corporation of India. They act as a central switch between both of this. Now the next topic is PRB, or the Payment Regulatory Board. Now first coming to the current affairs, or why PRB was in the news. The government, that is the central government, had proposed to set up an independent payment regulatory board in order to oversee all the payment systems in the country. So RBI had opposed this direction or the recommendation of the central government in order to create an independent payment regulatory board. That is why it was in the news. Now coming to the background of this, it was according to the Subhash Chandra Garg committee report, or the panel report, that proposed a payments regulator for overseeing all the payment systems in the country. So background is that a 7-member government panel was headed by Subhash Chandra Garg, and this panel recommended that there should be a payments regulator that should be established independent of the RBI. And according to the recommendation of this panel, central government recommended for the creation of a payment regulator, but RBI had opposed it. Why did RBI oppose this suggestion of the government? RBI cited the report of Ratan Vatal committee. So the Ratan Vatal committee was on digital payments. These committees are very important. So Ratan Vatal committee is regarding digital payments, and the recommendation said that establishment of a PRB, or a payment regulatory board, within the overall structure of the RBI would be better than creating an independent organization. So RBI said that even though government creates a payment regulatory board, this should be within the control of the RBI. So this was the contention between RBI and the government regarding the payments regulatory board. Now the next topic is participatory notes, which is also a very important topic for your preliminary examination. Now coming to the current affairs, there was a decline in the quantum of investments that is coming to India through the participatory notes, and this was because the watchdog of financial system SEBI had applied certain stringent norms in order to check the misuse of participatory notes. So therefore participatory notes were also in the news frequently. So we'll see what is participatory notes. So what is participatory notes? It is also called P notes. Now these participatory notes are used by overseas market participants as an investment. So if an overseas market participant, if they are not willing to register themselves as a foreign institutional investor or an FII, participatory notes are used in order to make investments in the country. So here what is to be remembered is that P notes are not issued in India. They are issued by an India registered FII to other overseas investors. So these are not issued in India, but these are issued by foreign institutional investors who have registered in India to other overseas investors. So what will happen? The FII, or the foreign institutional investor, will be the entity to initiate a transaction in our stock market, which will be on the behalf of foreign clients. Now what are the concerns with participatory notes? The first concern is the anonymous nature of the investment, because investors could be beyond the reach of the regulators. So who is investing? That is anonymous, and it is not issued in India. It is issued by a foreign institutional investor who is registered in India to other overseas investors. So it definitely brings in an anonymous nature to the investment. So that itself is the biggest concern here. And the second concern is regarding money laundering, whether it can lead to money laundering. So it can be used by wealthy Indians as an instrument of money laundering. So that is the second concern. So based on this, SEBI had issued stringent norms for issuing participatory notes, and therefore the quantum of participatory notes came down in India. So the investments through P notes came down, and that's why P notes are important. Now next one is commercial papers. Let us first understand what is commercial paper. It is an unsecured loan raised by the firms in money markets, and this is done through instruments issued in the form of a promissory note. So what is the significance of commercial papers? They have become one of the popular routes for corporates in order to raise funds when compared to loans from banks in the recent times. So the corporates or companies, Indian companies, use commercial papers as an instrument in order to raise loans or funds rather than taking bank loans. So how does it work? A commercial paper, it's an unsecured loan, and since it's an unsecured loan, they are mainly raised by highly rated corporates or public sector entities. We will come to the details of it. Now understanding the commercial papers, it's an unsecured loan that is raised by the firms from the money markets, and this is done through issuing promissory notes. And the commercial papers have a maturity of minimum 7 days and maximum up to 1 year. So definitely this is a short-term borrowing by the firms from the money market. So commercial papers are short-term borrowings from money market. And why commercial papers are popular? This is because of surplus liquidity in the market. The short-term borrowing rates in the money market is very less after the demonetization. So when the liquidity is more, it means that there is more money supply in the market. So when there is more money supply, the interest rates will go down. So there is lesser interest rates in the market post demonetization, and therefore commercial papers are very popular in the sense that they provide more interest rate than other investments. So what are the advantages of issuing CPs or commercial papers? It is a cheaper source of fund, and the procedural requirement is also very less. For example, for securing a bank loan, the procedural requirements are very important and time consuming. And it is also a cheaper source of funds for the corporates. But what are the key challenges with commercial papers? Commercial papers have certain limitations. For example, we have seen in the beginning, it is an unsecured loan. That means the investor in the commercial paper, they will largely prefer highly rated corporates or public sector entities because it's an unsecured loan. So those highly rated corporates can easily issue commercial papers. And the second challenge is that it is also seasonal and it is also vulnerable to liquidity conditions in the market. So these are the important facts regarding commercial papers. Next we will discuss about the PCA framework or the Prompt Corrective Action Framework of the RBI. So under the Prompt Corrective Action norms, the RBI can place certain restrictions on the commercial banks that are placed under the PCA framework. For example, they cannot expand their bank branches, they have to stop paying dividend, or they cannot issue new loans or large loans to the entities or individuals. So any kind of restrictions can be put by the RBI on the commercial banks. Now we will understand what's the background or when is PCA invoked by the RBI to the commercial banks. So PCA is based on 3 important criteria which is very important. You should understand 3 of them. First one is return on assets. Second one is CAR or capital adequacy ratio, and the second one is net NPA or net non-performing assets. The return on assets is based on the profitability of the bank. That means how much return the bank is able to make on the assets invested. So it directly reflects the profitability of the bank. The second one is CAR or the capital adequacy ratio. So it reflects the ability of the bank to face any kind of risk. And the third one is NPA or non-performing asset, which reflects on the asset quality of the bank, the quality of the asset. If NPA is high, it means there is lack of quality for the assets of the bank, and for a bank the assets are mainly the loans issued by the banks. So based on these three parameters, RBI will decide whether a bank meets the thresholds or whether it has breached the certain thresholds regarding risk. So in case if a bank has breached certain risk thresholds, RBI can invoke PCA or the prompt corrective action framework against the banks. Now again, if NPA crosses 12% and if there is a negative return on assets for consecutively 4 years, RBI will invoke PCA or prompt corrective action. And under PCA, there are two types of sanctions. First one is mandatory sanctions and second one is discretionary sanctions. Now, what is meant by mandatory sanctions? Mandatory sanctions include restrictions on dividend, branch expansion, directors' compensation, etc. While discretionary sanctions means curb on lending, deposit, these are all discretionary sanctions. So, mandatory sanctions are more important because they are applicable to all banks that has come under the PCA, while discretionary sanctions are applicable only to certain banks based on the performance. If they are very poor in their performance on these parameters, the discretionary sanctions like curbs on lending and deposits will be imposed by RBI. But mandatory sanctions like restrictions on dividend, branch expansion, directors' compensation, etc. are invoked on all banks uniformly, which comes under the PCA framework. Now, what will the banks do if the PCA is triggered by RBI? So, the banks, if the PCA is triggered, they are not allowed to renew or access any costly deposits or take any steps to increase their fee-based income. They have to also conduct special drive to reduce the stock of the NPAs, and they should contain generation of any new NPA or non-performing assets. So they will also be not allowed to enter into any new lines of business, and RBI will also put certain restrictions on borrowings made by the banks from interbank market. So all this happens with the banks if PCA is triggered by RBI. Now in this lecture we have covered 9 topics that are very important for your UPSC Civil Services Preliminary Examination. In the first lecture also we have covered 9 topics. So altogether with this first and second lecture we have completed 18 very important topics for your Civil Services Examination. So I'll continue with this series. In the next video also we will complete the banking and financial sector, then we'll move on to the next module, that is external sector. With next video we will try to complete the financial and banking sector. So please follow our channel for more video updates, and also the updates of my videos and PDFs shall also be available on my Facebook page. You can follow my page for more updates of my lectures and PDFs, and you can also write to me at joyce.studyiq@gmail.com for any of your queries or suggestions. Thank you. Hello my